The Australian property market. Is it about to change forever? Because of one man's actions on the other side of the world.
U.S. President Donald Trump.
Allies for almost a century, but tonight, a relationship damaged.
Trump tariffs have been wreaking havoc on the global economy. Hedge fund manager Ray Dalio even speculating of a possible recession in the US. Experts might be talking recession, but Trump's convinced these tariffs are going to help America, even if it's at the expense of the rest of the world.
I'm not aligned with anybody. I'm aligned with the United States of America.
14,000 kilometers away. Do we actually need to be bracing for an economic impact as Australians?
If everyone's trying to sell a house at once in a little market, then everything just tanks, right?
If we're not getting a level of government revenue generated from our mining sector, it has to come from somewhere.
I guess there's an asterisk beside it. It's not that it can't fail, it's that the government can't afford it to fail.
This episode, we're going to be diving into the detail and answering the key question from 5 Australian property experts talking in their field of expertise.
But what's that all mean for us here in Australia? That's probably the most important thing.
What do Trump tariffs mean for financial markets and taxes for us as Australians?
Hundreds of megatons over to America each year, and it's all Australian-made steel. So we will see if this continues on between China and America, what we sell to China reduce.
We speak with property investor and accountant, founder of Quartile Partners, Jeremy Iannuzzelli, to find out more. How about what these tariffs could change in terms of borrowing power in the banks right now?
It could be anywhere from making it harder to release equity. They could be changing living expenses as well.
Property investor and mortgage broker Morgan Bushell talks tariffs and rate changes and what might affect you when it comes to buying a property.
When rates go down, policies actually get a little bit tighter.
And how about the effect it could actually have in the market, actually buying a property?
Throughout the course of history, whenever interest rates go down, property prices go up.
We speak with founder of Housefinder and a property investor with a mammoth portfolio, Simon Loo. Is there about to be a buying frenzy?
By the time you think it's time to sell, everyone's thinking the same thing.
And construction costs. We're talking with Property Developer Network's founder and property developer himself, Rob Flux, who has literally just come back from China this week.
Construction methods for a very long period of time, and we're not embracing new technologies to build our houses much faster. We had a look at some factories very, very tiny and absolutely mega scale.
Speaking more about the potential opportunities that we have as Australians when it comes to construction.
For Australians, I think the more impact would be coming from the slowdown from our major trading partners like China, Japan, or Korea.
And finally, Junge Ma, lead research analyst from InvestorKit, opens up the data she's been tracking since this all began.
The drop in consumer confidence is not the only reason why everyone's saying we will be seeing more rate cuts. It's more based on the assumption that...
My name's Todd Sloan. This is the Pizza and Property Podcast. This episode is powered by Suburbs Finder, Full Circle Finance, Quartile Partners, InvestorKit, and Housefinder. More about our amazing show sponsors in the show notes below. But right now, let's get into answering these key questions about how Trump's tariffs may or may not be affecting us as Australian property investors. Jeremy Iannuzzelli, how are you, man?
Always a pleasure. Yeah, looking forward to talking about today's topic. It's really a passionate one. I love economics, so I'm excited to dig down deeper into this and share views.
Man, and it's the topic itself is extremely topical. It feels like this is on the tip of everyone's tongue. And there's a lot of questions that need answers. And obviously, being a property investing podcast, we want to really frame these answers for Australian property investors, which is why my first question to you, being both a very accomplished accountant, entrepreneur, and property investor, is realistically, how could the Trump tariffs actually affect Australian property investors, both wearing your investor hat and your tax accountant hat at the time?
Yeah, I think it's important to understand actually what a tariff is. It's, hasn't been on the tip of everybody's tongue for a number of years, although it's now connected with the Trump name being a tariff. But essentially speaking, it's a tax that we charge other countries to export goods in our country. So it was really used to even the playing field for governments to make more money from services or products that other countries were providing into our country. And it was a way to protect industry. So one of the best examples, Australia Australia had for a number of years when we did have a manufacturing industry here for cars was that there was a tariff on European vehicles and American vehicles, and that kept a very strong Australian manufacturing car industry for many years. Then it was heavily subsidised by the government, and then at that stage it was just be too unattainable, too expensive, and the government killed the car industry overnight. So tariffs are a tax that one country will pose on another while bringing goods and services into that chosen country. So that's a little bit of the background of a tariff. What Donald Trump's done is he's obviously made America first, America great again. That's his slogan. That's his pitch line. That's been the whole way through his overall tenure as a president prior to it. And as of today, 47th president of America. His goal is very simple. Now, a lot of people behind the scenes in the economic world understand that what he's trying to do is really reduce interest rates in the country. He's trying to bring back core manufacturing to the country. He's trying to control a lot of what the country is producing. Instead of going to, say, someone like China, where they're producing a lot of pharmaceuticals and other stuff, he's now bringing it to America. But what's that all mean for us here in Australia? That's probably the most important thing. Well, what's this tariff 140, 200%, 250% that America is imposing on China? What's it really mean for us here in Australia? And it means a lot. Initially speaking, we'll see, and I've mentioned this in the past to many people, we'll see a lot of cheap goods and services being dumped here in Australia because it's got nowhere to go. China's produced all this stuff in anticipation for the world's largest consumer to buy it, use it, but it hasn't happened. It's too expensive. Literally overnight, as things are on the ship, they've got 140, 150% more expensive, and ships were actually turning around, but making their journey. They're actually stopping halfway through and turning around and trying to find another port to dump their goods. So Australia will see a bit of a benefit of that, and we've seen that. Cheaper petrol prices over the last couple of weeks, dated as of today, being in April, late April. So we've already started to see a little bit of that blow-by of the
I don't know if I should.
Tariffs taking effect.
I was sorry to jump in there, Jez. I don't know if I should mention names, but I was actually on the phone to a property investor that is on the show a bit. And I was like, "Oh, whereabouts are you?" And they're like, "Oh, I'm in China. I'm going to a handbag factory. We're taking advantage of him and his wife were over there already, like shopping, taking advantage of all this."
It's very cheap. A lot of goods and services need to be dumped into other countries. But where the economic outlook for Australia is, and where people like Jim Chalmers, which is the Treasurer of Australia, has been run around like a headless chook to make sure that he firms up the relationships, is very simple. If China slows down, and China uses a lot of our Australian rare minerals, and they actually then produce something with it and send it overseas, literally send steel by the hundreds of megatons over to America each year, and it's all Australian-made steel or Australian-produced and sourced minerals for that Chinese-made steel. So we will see, if this continues on between China and America, what we sell to China reduce. Because then we need to now find other markets. Because if China have lost their huge main purchaser of Chinese goods and services, and we are one of the major suppliers to China from a raw minerals perspective and a more raw minerals sector, then we'll actually start to see a slowdown in that portion. So that is what potentially we may lose, which is our strength in the raw minerals sector, being able to export to China and then ongoing export to America.
So can we talk about that in the sense of building materials, costs, sourcing them? Is that the kind of thing that's potentially going to make building a house more expensive here in Australia?
Not necessarily. What it may do is it has a flow-on effect, and similar to where we had our mining boom and bust, is that the mining sector does employ a lot of people, and those people are, earning good money, very good money. And there's a lot of other connected sectors to it, which range from train drivers or maintenance and cleaners and chefs. All these major mining sites need chefs and cleaners. So it's not just the people on the beat, essentially mining or fixing the machines. There's a lot of other auxiliary services and auxiliary occupations off the back of it. If that slows down, we'll start to see those people head back into the normal private sector outside of mining, looking for jobs, and they're not going to be having the disposable income that they had in the past. So potentially, if China does slow down off the back of the tariff sticking with what America's imposed, we will see a ripple effect in the months to come or the years to come, because it's a big moving beast, and it takes time to get that engine hot again and roaring like it has been over the last 5 years.
Okay, so you're still looking at the Australian property market as a pretty safe place, safe store of wealth, because like I'm asking everyone this question. The stock markets around the world, doesn't matter which country you're in, most of them have tanked already. So why is the Australian property market, if you do agree, a safe store of wealth right now?
Look, we've still got a shortage of properties compared to the people that are living in the country that are wanting properties. So at the moment, our supply levels are still relatively low compared to the demand that's still out there. So that's why properties are almost, considered gold by all Australians and by, believe it or not, many people around the world. I speak to a lot of, people living in other countries and the system from a tax perspective. And one of the things they say is your bloody Australian property market, without a doubt, is the best property market in the world. And it is seen as gold because we really do have, a beautiful country. We do have beautiful industries from a service perspective. We've got a great economy, and property's seen as one of those safe stores and has been for a number of years. But our supply levels is what's keeping our demand strong. If it was the opposite, we did have a substantial oversupply of houses, then it wouldn't be a safe store of wealth. We'd be seeing things generally come and slide downwards. But probably one of the main things to mention, and while it is a good safe store of wealth, it's not risk-free. There is always going to be some risk investing in property, but generally what you'll find, and it's common between most economists or all economists, is that the property market tends to follow the share market. The share market is a very active investment industry. It's moving at seconds at a time, at milliseconds at a time, where the property market's quite a slow-moving beast. It takes time for a property to go on the market, then to settle and that data to get out in the system. But generally speaking, what we'll find is there may be potentially a little bit of a slowdown if the stock market doesn't recover. Because as people look at their supers, they feel a little bit poorer if it's going down in value. Their shares externally, if they're holding it, on a local exchange or overseas exchange, if it's going down, they feel a little bit poorer. Yep. So that's something to consider, that there could be a little bit of a pass-through to the property sector if the share market doesn't rebound. But generally in this country, we've been pretty insulated because we've had a lot of migration coming in and we just haven't been able to keep up with the amount of dwellings that's needed to house these people.
Okay, so what I'm really hearing from you as far as like how it's actually going to have a knock-on effect for us as Aussie property investors is, apart from seeing a whole bunch of potential goods and services fly into Australia, or more so float into Australia, potentially really cheap, we're also going to be seeing potentially a bit of difference in the mining sector, because if we're the ones exporting all the minerals that get turned into the steel, if they stop buying from us, that could have a bit of a knock-on effect to it. People may be leaving the mines, looking for other jobs back in the metro cities in Australia. But as far as the house side of things, you're not saying anything about rents rising. You're not saying anything about taxes changing. You're not saying anything about prices dropping, going up, anything like that. So you're really seeing the housing side of things pretty stable through your lens?
I think it should remain pretty stable, again, brought on by the migration. Probably the one thing that I will mention is that we've had a very good run, especially during the COVID pandemic period, generated from the raw mineral sector. The Labor government over the last couple of years had surpluses off the back of the royalties that was collected from mining. Yep. So mining's definitely been pushing Australia forward. There's no doubt about it. If that does not have the bravado, the strength that it's had over the last 5 years, and they're forecasting 10 years of surpluses. Anyone who watched the latest budget that was released saw that we've got 10 years of potentially deficits ahead of us. That will force a lot of tax changes, a lot of legislative changes, because the government still has grand plans here in Australia to reduce infrastructure, and it's still got a social security system that needs to look after, and a healthcare sector, and NDIS and Medicare and all these other linked systems. If we're not getting a level of government revenue generated from our mining sector, it has to come from somewhere. And one of the easiest things to pinch from government revenue perspective is generally our money from our earnings, which is our taxes. So I do think that there is some big tax legislative changes on the horizon that will come into effect. I don't know what they are yet, but if we don't start seeing some revenue increases from mining over the next 2 to 5 years, or whatever government's in Parliament at that particular stage, I think they're going to find it very tricky, and their hands are going to be very much held behind their back. So I do feel there might be some big changes happening in tax legislation over the next 5 years. What they are, don't know, but they've always talked about taxing our own home, and maybe taxing inheritance. We're one of the only countries that that don't tax inheritance. So that's something to consider. But they are definitely on the horizon if our mining sector doesn't come back and come back strong.
I've got to poke the bear a little bit there, Jeremy. You paused a little bit about, I feel there's some major tax changes potentially on the horizon. Is there someone you've been talking to that you can't name, or what's this sort of thought coming from?
I'm very lucky. I get to speak to some very influential people in the area who, are in the know, and they're part of many different organisations that help structure tax legislation. But I won't say too much because it's all very hypothetical at the moment. But there is definitely talks on the table about finding other avenues where there's going to be a huge wealth transfer here in Australia over the next 10 to 15 years. And, that's something that the government's definitely looking at. There's a lot of wealth that the boomers have been brought up, and you look at the Greens who've been wanting to take away negative gearing for a long time, and potentially tax inheritance of these mega families that have been in holding wealth for a number of years. So it's around a lot of countries around the world, inheritance tax. We haven't had it here in Australia. I hope they don't do it, but it's something that's probably on the tip of their tongue and being questioned many times, I suppose, in the Senate and House of Representatives.
And when you say talks amongst the table, this is a table that actually makes decisions that affect all of us.
The table that get consulted with the decisions that affects all of us.
Right.
So not so much make. I won't take away the glory that our politicians have, but these are the people that get consulted.
Mate, I'd love to be a fly on a wall listening to the conversations at that table. But look, I would like to ask you then, finally, just wrapping this up, is there an opportunity here? I'm asking everyone this question. Is there the thing that we're going to look back on in 5-10 years time and go, I should have? Or is this just like a take a knee, ride it out? Like what's your thoughts on it, mate?
There's definitely two. So depending on which stage in life you're in, sometimes it's worthwhile to take a knee. If you're at the later end of your career and you're looking towards the next 5 or 10 years of your retirement, it's probably something for you to consider that, hey, just let it all blow by and take that knee, continue to work, save your money, boost up your super and all those other things. But if you're much younger, this is a great opportunity to look at those advantageous moments, those pips, those drops in the market, those periods of time where people are uncertain. Because if you've got plenty of years ahead of you, this is where a lot of people make money in what they call uncertain times. There could be drops in the share market, which is one thing to consider. But from a property perspective, this is people feeling like they want to ride it out, they want to wait. There could be a great opportunity for you to snag a bargain for someone or a property that's sitting on the market for quite a while for people waiting for interest rate cuts to come in. So, I feel that the Reserve Bank of Australia, through the rhetoric and the releasing of their notes, they're very much of the same view. They're uncertain, and in those periods of time where you're uncertain, it's always best to get in early, and that's where potentially we might see some rate cuts. They've been definitely factored in and baked into a lot of the forecasts. So if people are waiting for those rate cuts to happen, there's probably generally a number of other people that are waiting. So this could be that little bit of, slip in time, or that little bit of tear in the metaverse, as people want to call it, where you could be snagging a bargain right before the herd comes in and starts snapping up all the properties due to lower interest rates.
Got it, man. Look, thank you so much for jumping on the show. As always, you're an absolute wealth of knowledge. Jeremy Iannuzzelli from Palladium Partners. Thanks again for your time, mate.
Thank you, Todd.
So potential tax changes on the horizon, which sounds like a real peek behind the curtain potentially because of what's happening with the Trump tariffs. As far as the cautions are concerned, the big takeaway I get from that is the mining sector. Because if the mining sector doesn't have as much of a big buy and the big influence from China buying all of our resources, well, then there's potentially going to be a big gap in taxes. The government's going to want to get that money from somewhere. As far as the positives are concerned, there's always opportunity in uncertain times. Now, this is obviously within reason. If you're on a beach in Thailand and everyone's running away, don't run towards the wave. You've got to be smart about this. We're talking about financial uncertainty. We're talking about economic uncertainty. But it's the things of what's really happening here. There are so many people that have built multi-million dollar and in some cases billion-dollar fortunes from running towards what everyone is running away from. And the further we get down this episode and talk to Morgan Bushell, the mortgage broker, who's up next, Rob Flux, who's a property developer, who's talking about some amazing potential opportunities for different construction methods, more cost-effective construction coming from China, who has literally just been in China this week. But it's all of the things other people are looking away from that if you can potentially look a bit closer, it's where profits can be found. So keep your minds open to opportunity. But right now, let's have a chat about the financing side of things. I'm very much selfishly looking forward to this, to talk with Morgan Bushell from Full Circle Finance, property investor, mortgage broker, about What are the potential changes that we're going to see on interest rates moving forward because of these Trump tariffs? As well as how is your serviceability going to be affected as a property investor? Let's jump into the chat with Morgan right now.
Morgan Bushell, how are you, man?
Good, thanks, Todd. How are you?
Mate, very good. I'm pumped to have you on this panel because I want to be talking about borrowing. Trump is obviously making some big moves. China's responding to this, and there's changes. We don't know exactly what those changes are going to be because there's a whole bunch of different factors to this. Economically, we're talking about buying, we're talking about selling. But right now, I want to hone in on the potential borrowing changes that us as Aussie property investors are really going to see. And I know there's no guarantees, but right now, if I can just ask you the direct question, how could these tariffs actually affect our borrowing power?
Yeah, so chances are if these tariffs do come into place, that's going to reduce the banks are going to reduce their rates by following the RBA down.
Mm-hmm.
As a result of that, though, our borrowing capacity actually increases as well.
All right, so we're already talking about rate cuts happening and have been for some time now, but it is starting to happen. Like we had our first rate cut, what was that, like 2 months ago now? Are we talking Trump's tariffs are going to increase the amount of rate cuts in your opinion and from what you're gathering information-wise? Or are we talking more so now the same cuts, but maybe just a little bit sooner because of all this?
Yeah, I think if anything, it's definitely going to bring it forward a lot sooner. There was always an expectation that we were going to see more than one this year. I mean, everyone was talking about one happening next month. So at the time of recording, today is the 28th of April, so Monday. There's a big expectation that it was already going to happen in May, but I think with what's happening and playing out in the markets at the moment, this basically guarantees it. And in actual fact, I think the market's already actually priced it in.
I know a few of the majors have already started dropping their rates ahead of the RBA. Like I think Westpac dropped it 25 points the other day for some products.
Yeah, them and like Macquarie and a few others. So it's starting to filter in already.
And as far as forecasts are concerned, what are people looking at potentially? Like, is this something that over the course of a year, the forecasts are coming down 0.5%, 1%? How much are we looking at?
Yeah, I mean, look, it varies between institutions and economists that you'd speak to, but I think it's anywhere from like 0.5% to 1%, depending on where you pay attention to.
All right, so 0.5% to 1%, and obviously this is still in the potential bucket here, but if it was to actually go down a full percent and maybe pushed forward, like happening a little bit sooner, what is someone actually looking at? If they're holding like a $500,000 mortgage, what does that translate into dollars as far as the savings concerned?
So if their loan is on interest only, they'll be saving around $400 per month on a $500,000 loan if rates dropped a full 1%.
That's spectacular. Okay, all right. So there's going to be downsides to this potentially with Trump's tariffs, but there's a bit of silver lining to it if you've got a mortgage by the sounds of things.
Yeah, more or less. So like, yes, borrowing capacity will increase, and depending on how you time it, you could use that to your advantage. However, there is also kind of a second side to this double-edged sword, whereas generally when rates go down, policies actually get a little bit tighter with banks. So that actually makes it a little bit harder to get lending as well.
Okay, so even if they come down and technically your serviceability is going to increase, when you're talking about policy changing, what do people need to look out for?
It's kind of hard to say because we don't know what they're going to change at that point in time. But I would just focus on what you can control on. It could be anywhere from like making it harder to release equity. They could be changing living expenses as well. So if anything, I'd probably focus on just keeping your living expenses low, focus on buying like good quality properties and stick to that.
Okay, so it's basically like interest rates looking like they're coming down. However, because these tariffs might make general living more expensive, it could almost be like a giving with the left hand, taking with the right hand kind of experience for us.
Yeah, more or less. So just keep doing what you're doing. That's probably the crux of it. And if markets go down, then that's what's going to happen.
So I've got to ask then, for yourself as a property investor as well as a mortgage broker, what gives you confidence in the Australian property market? Because stocks right now around the world, they're tanking. Like I've never seen so much red on my phone. And I don't follow stocks like super closely, but enough to know that there's some stuff happening out there, especially for some of the big companies. Why is Australian property a secure place to still put in wealth? Why shouldn't people be pulling out and running?
Yeah, so if you were to kind of compare stock market to property market, generally speaking, they kind of appreciate the same amount each year. The main difference, though, is that there's more volatility in the stock market. So if it's something that you don't really have a stomach for and you can just buy and not look at it, then probably property is a better asset to get into just because it's there, it's tangible, you can touch it. Over time also, like the rent will go up just like dividends on shares. So that's probably the main thing I would say about both of those.
All right, so the thing that gives you more confidence with it is the lack of liquidity really in the Australian property market. Like you can't just go, boom, sell your house in sort of 10 minutes.
No, and I mean, that's the risk with shares. Like, yes, you can leverage both. And with lending, there's things like margin loans. So if the stock market does tank and you've got a margin loan, the big risk is you may get margin call. Whereas with property, there is still that risk. It's just not as fast and as liquid as it is with shares.
Okay. So basically, the fast-moving nature of the stock market is kind of one of those things that makes it go a little bit more up and down. And if that's your lane and you do well out of it, fantastic. But for the property side of things, because people have been talking about a bubble in the Australian residential real estate market for 40-odd years now. And who knows? Maybe it's there. Personally, I don't believe it is the same way. But if there was going to be something to make it burst, to me, it would be these tariffs. Like it would be like super economic uncertainty. So if anything, if we're going to have more stability during a time of like, well, let's face it, instability, and it's still that market that's the go-to that's standing there as a concrete pillar, I think if anything, and only time will tell, it's probably more of a sign that this really is that store of wealth that has more protection to it.
Yeah, absolutely. I agree. So it's I think one of those things where we've just got to keep an eye on it, but also at the same time, be okay just to step back, have a moment, maybe look at it the next day and go from there.
As far as summarizing, as far as everything's concerned, rates are looking like they're potentially going to come down. It could help with serviceability. However, we don't know what's going to happen with the cost of living. So things like HEM, which is like household expenditure measure, might go up. There might be policy changes. So we might be seeing more people rush to the markets with more money, but we also might just see a little bit of a give and take situation where it kind of evens itself out, which sort of brings me to my next question, because I was expecting you to be a bit more like, nah, rates are coming down. This is good. This is still happening. But it's like, it's sounding more like it could actually just be almost a non-event with the give and take situation if it does play out that way. So my last question feels like it might be a little bit redundant, but what's the potential opportunity here for us as Aussie property investors that people might be looking back on nostalgically?
From this perspective, looking back like a decade. So back then, for example, the Logan property market in Queensland was a good opportunity to buy. And at that point, rates were going down. We're seeing almost a bit of a repeat, but maybe not as aggressive. I think for people who are thinking about buying and considering the Trump tariffs, I would just focus on what you're doing, like buy now, because if rates do drop, you may potentially be like kicking yourself later and thought maybe I should have bought more before property prices do rise as well.
So basically there is potential still for market uplift. And if I'm hearing you right here, if HEM, if policies, if everything else stays pretty much the same and all of the rates do end up dropping, and then people are having an extra 400, 1,000, however many thousands of dollars potentially in their back pocket, then that is the thing that maybe mixed with a few other different economic factors, which we'll get into later in the episode with a few other experts, could actually really set the fire for more growth in the market potentially. But if it doesn't happen, and maybe it's like a rate drop and then all of these other increased expenses, maybe it's a bit of that non-event. So that really seems like the risk that needs to be balanced. So if the numbers for your investment still work, no matter which way the market's going, I think that's the most important thing. Not betting on it has to go in this direction for everything to work, then that's when you're probably a little bit safer. But as we always say, this is not financial advice. Please seek independent professional financial advice. But the biggest takeaway that I'm getting from you today, Morgan, is rates have got some very strong potential of coming down sooner than what we're originally thinking, but be really cautious and actually have a look at the policies that the banks are actually shifting or potentially shifting, because it could be a bit of a give and take situation.
Definitely. It could go either way. We don't know, but I would just say work very closely with your broker on this, map a few things out as far as scenarios go, and just stick to the plan. Like, I guess as the saying goes with property, the best time to buy is yesterday. The next best time is today. So that's, I guess, my kind of parting words on this.
Love it. Morgan Bushell from Full Circle Finance. Thank you so much for jumping on the show again, mate.
Cheers, Todd. See you, mate.
So in anyone's book, big win for interest rates. Like, what was the example? I think it was $500,000 was about $400 a month if rates come down by 1%. And there's obviously this is all speculation at this point. Like I'm quite literally recording this on the 2nd of May at like 5 p.m. right now. We might be in for a 25 basis point cut for this first RBA board meeting in May. Maybe we are in for a 0.5%. But either way, there are so many professionals right now, Morgan included, that are looking at this going, I think it makes sense for us to be in for multiple rate cuts. And selfishly, as someone that like B and I have got millions of dollars in debt, 1% off would be amazing as far as cash flow is concerned. Now, whether you've got millions in debt or hundreds of thousands of debt, it doesn't matter. It is a massive relief. However, the big takeaway that I want you guys to get from this, and what I really got from talking with Morgan, is it's that potential like taking with one hand, giving with another. If you're looking at refinancing, and if the rates do come down, whether it's 25 points, whether it's 50, whatever, don't put off talking with your broker. Don't go, yeah, I'll get to that. Because if that ends up happening and they change policy, because maybe cost of living does actually start increasing and the banks go, oh, because of this, we're going to adjust HEM, like Morgan's saying. That could potentially be the difference between you refining or not refining, you getting a good rate, you not getting a good rate, you being stuck with a lender that you thought you could refinance away from, or getting into a bank where you've got such a more comfortable cash flow. The big takeaway, again, if you're looking at refinancing, do not sit on your hands, because this could be a little window of opportunity here for all of us as Australian property investors. And I'm looking forward to unpacking a little bit more of the detail behind that with the economic side of things with Junge Ma coming up a little bit later in the episode as well. But right now, let's talk buying with Mr. Simon Loo, a man with a whopping, I actually can't remember if it's $40 million or $50 million, just a massive portfolio, has literally bought more houses than you and I have probably even walked inside of. I want to pick his brains on what's going to change. What is he actually forecasting? Are they changing the way that they're buying? Is he changing the way that he's investing because of this? Or is it business as usual? So right now, let's jump into the chat with Simon Loo.
Simon Loo. Mate, I appreciate you taking out some time on holidays.
No worries, man. It's all good. It's always good to break it up. You can't just eat and drink and do holiday stuff all the time. So it's good to get myself back in the groove every now and then.
Yeah, man. Well, I'm very much looking forward to your opinion on this. And for anyone that's listening on Spotify or iTunes, there's quite a magnificent view of Taipei 101 directly over Simon's right shoulder there.
Pretty good, huh? It's pretty good.
It's amazing.
I thought I'd include some skyscrapers in the background to make me look more legitimate, you know what I mean? So
it's working.
That's good. That's good.
Well, Matt, on the topic of skyscrapers, a man that has built a few before and that is very much the hot topic at the moment, Donald Trump. And I wanted to talk to you about the tariffs that he's imposing, and realistically from a buyer's perspective, because it's literally what you do. You buy hundreds and hundreds of properties a year. You've bought probably close to 100 yourself personally as well, like for your own portfolio. I want to talk to you about how these tariffs could actually affect the buying side of things in Australia, because this is turning into a global issue now.
It's definitely the flavor of the month at the moment. You know, it's everywhere in the media. There's definitely been a lot of press about it. I think it's one of those things that, you know, very, very reactionary at the moment. It's one of those things where I think a lot of people forget that as quickly as these tariffs can come into the world, they can and will change equally as quickly as well. And I think we've seen that ever since they were introduced, you know, with the 90-day pauses and, you know, increases but only for China and all these countries coming to the party now to make different trade deals and all that kind of stuff. And every time something like this happens or gets announced, you know, equities and shares and currencies and everything, they go up and down like crazy. But property has always been seen as a safe haven, you know, away from that. And I don't think that trend will change. In the past 15 years that I've been investing in property for myself and for investors as well, you know, we've seen so many things. You know, we've seen good economies, we've seen bad economies, high rates, low interest rates, housing booms, mining booms, natural disasters, all these global events, COVID, you know, and I think throughout that time, personally, I've never sort of tried to go, okay, now something's happened. Now it's time to get into the market and go crazy. And equally as much, I don't think there has been a time where a specific event has happened and then there was like a mad bull rush, you know, into the property market. The only time that I can think of that there was a bit of that was when...
During COVID?
During COVID, when COVID immediately finished. You know, there was a bit of a mad rush back into the market. Obviously, these tariffs eventually, if they stay on, will affect interest rates. You know, interest rates are likely to come down. I think everyone knows this, especially over the shorter term. And throughout the course of history, whenever interest rates go down, property prices go up. You know, the demand for property increases. But I think we're in such a weird time at the moment because there's so much cost of living, there's so much of all these sort of pressures on everyone, you know, at all levels. I think it's very important to keep that in mind, that that will actually probably get worse, you know, if these tariffs were to stay. You know, things like groceries and everything else will become more expensive for people. So I don't know if people will suddenly have all this money, all this borrowing power to suddenly rush back into the property. So where I think properties will be a little bit more high in demand are actually affordable properties. You know, properties where it's continued to be a necessity, an absolute needs must, you know, for people to live in at all levels. You know, whether you're decent income, whether you're low income, whether you're feeling the pinch. You know, these properties in these big cities where jobs and income are still consistent, where if you're earning an average income, you can still afford an average property. I think that end of the market will continue to thrive.
Because that's something that gets thrown around a lot in the media, is the average income can't actually afford the average property. But typically that's quoted as like an Australia-wide stat. So you're talking about locations where the average income can afford the average property instead of averaging it out, including all of your double bays, your Penrith, like all of your more, it's not Penrith, or all of your more expensive locations. And you're seeing those spots as potentially being spots that could have more of a buying opportunity. But then to rewind a little bit more on what you were saying, you're thinking this isn't going to be some mad buying frenzy. Like this isn't the opportunity of a lifetime. This is just more, there could be a bit more pressure on that sector of the market. Have I understood you right?
Yeah, I don't think there'll be a mad frenzy because I think, like I said before, a lot of people are going a little bit cautionary about how volatile these tariffs are. You know, it's not like, you know, Trump just imposed these tariffs and then they just stayed the same. They've changed so much and they will continue to change. And then we've got all these other things like the upcoming election, you know, in Australia and all this kind of stuff as well, that all these different parties are talking multiple housing policies. So I think people are a little bit cognizant now about the fact that, low interest rates doesn't immediately equal time to go crazy into the housing market. And then on the other hand, you've got people that are literally, you know, can they even afford to buy more houses because everything's so much more expensive, you know, on a daily basis. So that's why I always lean back to the affordable, you know, focusing on the needs must type properties, because I don't think that will ever go out of fashion. You know, the good thing about property is if you're buying a certain type of property, people need to live in them. You know, it's not something like people can do without. So I think as long as we stick to that, and I've been sticking to that for the past 15 years, and it's done extremely well for me during good and bad times. So I think there'll be a little bit more reactionary demand for this type of product, but I think over the long term, steady as she goes.
So why is this different then? Because like you look at the stock market, I think Tesla's kind of halved in value. Google's gone down drastically. Like, so many, I'm not going to just name every stock, but like so many stocks have gone down like incredibly. Understand, obviously, they're much more of a liquid asset. But for people going, now's different, Simon. It's not the same thing. We've got someone at the helm of essentially the world almost, making these rash decisions. I think last time I checked it was up to like 240% tariffs on China. Like they're just getting crazy. It's different now. What makes you go, nah, it's not different now? There's stability.
Well, it's definitely different for the share market. It's definitely different for, you know, a multitude of different assets. But what I'm saying is for property, I think it's no different to, say, COVID. You know, in Australia, at least, during COVID, the housing market here was pretty insulated, you know, from any sort of turbulence. I think at the end of the day, it comes back to the fact that everyone just needs a home to go to. Yeah, not everyone needs Tesla stock. So yeah, I think that's the major difference. So as investors, we need to be exposed to that necessity, right? And coming back to your point, not, you know, what you said before about Double Bay, not everyone needs that penthouse in Double Bay. You know, not everyone needs, you know, that sort of rural property or the sea change, tree change. You know, everyone needs to live in an area where they can get a job easily and quickly and consistently. You know, i.e. major cities. Everyone needs a roof over their heads to find a city, find a location where if someone is earning an average income, they can find a decent, affordable house to live in. That's the kind of stuff you want to keep buying and expose yourself to as investors, because that will never go out of fashion. Tariffs, no tariffs, interest rates, whatever, it'll stay consistent. That's been my experience. And I don't think that will ever change unless there's like some massive major disaster. If this tariff war turns into a real war or something like that, then, but I guess if that were to happen, we're all stuffed. So
I think we've got a different, we're making a very different podcast then.
Yeah, exactly.
Mate, my final question that I'm asking everyone.
Explosions in the background instead.
I really hope this stays as a joke. Yeah. Mate, the final question that I'm asking everyone, I feel like I've already got an answer to you, but what's the potential opportunity here that everyone is going to potentially look back nostalgically on? The same way, like I know you got a lot of grief 10, 15 years ago. You bought up huge in Logan. At the time, it was like, what are you doing? You're an idiot. And now it's the narrative is, oh, it was easy for you. You just bought cheap houses in Logan. Like, is there going to be something along that similar kind of vein that's like, oh, well, it's easy for you. You guys just bought up heaps during the Trump tariff. Or do you know what I mean?
Just keep buying affordable properties. Stick to the fundamentals. Don't make any rash decisions based on these global events, right? It's, there's a lot of speculation at the moment because of these tariffs. And I can see some of that narrative being filtered into the property market. I mean, there's talk now of people just going, oh, I'm going to buy a house and or buy an investment property and then, sell it after the capital gains tax discount after 1 year. So there are some people that are treating property now as stocks. And I think that's extremely dangerous because, like I said before, what's going to happen to these tariffs is just, continued volatility. It might even completely be gone within weeks. Who knows, right? So if you make any crazy decisions now based on these tariffs, I think it's really stupid. So stick to the fundamentals, base it on where people actually need to live. These are big cities, lots of jobs, affordable housing areas based on median incomes. Like that stuff will wade through all of these ups and downs and will continue to grow in the long term. Where people are moving to, I think that's super important. There's a huge shift in population growth, or population movement in Australia at the moment. Find out where people are moving to en masse in these major capital cities and focus on those cities. Don't buy in areas that are at the very top of the market, like Sydney, for example. Don't buy the double bay penthouses where it really is a necessity. And don't buy in, random regional areas where, they're building like a new highway or something. That stuff isn't going to last. So I think when we look back on in the future at how these tariffs have impacted the property market, I think you'll see a lot of people losing their shirts. I think you'll see a lot of people that just continue doing or had continued doing the thing that they've been doing before the tariffs and before COVID and all this kind of stuff, just buying steadily, continued investing in the fundamentals. They're the ones that are going to do well.
Open up the losing your shirts bit. What were you talking about? Those are the people that are buying the penthouses or buying like the risky regional what do you actually mean by that?
Well, potentially, people who are over leveraging, people who are, treating property like stocks, buying and selling based on these announcements, based on these changes in the world. I think that, based on mining booms, like everything if you look in the past 15 years, people who bought based on hype, and missed out on the selling opportunity or didn't know when to sell, which is extremely difficult to time in property. By the time you think it's time to sell, everyone's thinking the same thing. And then if everyone's trying to sell a house at once, there's a little market, then everything just tanks, right? So it's not like, don't treat housing as stocks. Treat it as a safe haven. If you want to gamble your money, if you want to trade based on these events, there are definitely assets that will allow you to do that. But I think for housing, it's more just steadily moving onwards.
And the word that you've just used there for me is if you want to gamble your money. Like this isn't property gambling. This is property investing. So what I'm really hearing from you here is, whilst there might be some kind of a potential short-term spike depending on how long this lasts, which again, that's the massive caveat. It's like this could all blow over. This could blow over before this episode even airs. Like, do you know what I mean?
Yeah.
The editing team might get to work on this.
Maybe.
Yeah, we don't know.
I don't know if anyone will ever see this.
or potentially this could go on for years. That's the whole thing.
Yeah,
but it's that speculation that shifts it from the investment point of view to the gambling. But what keeps it at investing is sticking to those fundamentals, making sure that you're buying good quality stock that's in the affordable price range. Because like you said, no one needs a double bay penthouse. It's lovely to have, but people do need 3-bed, 2 baths, 3-bed, 1 bath, 4-bed, 2, like they in affordable locations close to work.
Yeah.
But mate,
and stick to bargain deals only.
Okay.
Stay below market value, honestly. That's the only thing that'll see you through life.
Man, I love it. Simon Loo from House Finder. I better let you get back to your holiday, mate, but thank you so much as always for jumping on the show.
All good, all good. Thanks, Todd.
I went to a meetup event in Sydney recently, and shout out Ricky as well. Thank you very much for inviting me. And apart from meeting some awesome other property investors and having a lot of chats, Simon actually came up in conversation a few times. 2 major things that came up. One, everyone loves Simon's laugh. It is an infectious laugh. And yes, that is how he normally laughs. He's not putting it on. A few people asked me that. But 2, people kept saying, I just love how he's just straight to the point. There's no nonsense. Let's get to it. Well, in this chat, he did not disappoint. Just looking at my notes here, it's like, don't react emotionally to global events. Stick to affordable properties in high demand areas. Housing remains needs. It's not a speculative asset the same way. It's not stocks. It's not super liquid. And opportunities lie in stability. Like, again, straight to the point. Super calm. It's like, it is what it is. While so many people are losing their minds about the uncertainty, about all of the what ifs. There's Simon. Just chilling. It's not the first global event and it's not the last global event. Check this out for a second. This is a graph of Australian house prices from 1992 to 2022. Now look at the amount of massive things that happened. And I encourage you, like, hit pause right now, really soak this up for a second. Because I feel that this beautifully illustrates Simon's point. So many massive things happen. It depends on how old you are, right? You might be 18 years old watching this going like, what's Y2K? I don't remember that TV show. Or you might be 67 years old going, Todd, I've lived through even more things than that. This is only a blip. That's my point though. It is just another blip. It's another headline. And that's one of the big comforts, the big takeaways that I get from listening to Simon. It's not that markets can't move up and down. It's not that you can't lose money in property. It's not that you can't make money in property. It's about sticking to the fundamentals and just keep moving forward. But right now, it's time to talk to one of Australia's leading property development educators and property developers, Rob Flux, who has quite literally just got off a plane. When I recorded this section with him, he literally, I think it's 4 or 5 hours ago, got off a plane from China. There is so much to unpack with Rob. So I'm going to get into this one with him right now.
Rob Flux, I'd ask how you going, mate, but I know you just got off a plane, so I already know the answer to that.
I'm 4 hours off a 10-hour flight directly from China, mate.
So a little bit jet lagged?
I am a little, yes. Let's just say I'm going to sleep like a baby tonight. So, but mate, I'm feeling pumped actually. So
I was pumped to actually have you on this panel, China aside, but the fact that you've literally just gone on a factory tour, you've been speaking with government officials, you've been immersing yourself in this. The problem that a lot of people are, well, exactly that, looking at as a problem. I should say the changes a lot of people are looking at as a problem. You ran to it like the opportunity that I feel you're about to unpack that it could be for a lot of us. But before I get into my questions with you, mate, is there anything that you wanted to set the stage with, Rob?
Look, I went over there specifically to achieve 2 things. Firstly, we've got a massive housing crisis here in Australia, 1.2 million homes needed in the next 5 years. And we've got the most unaffordable housing situation that we've had in, I don't know how many years, like it's an eon. We are the worst housing affordability that we've got. And so recognizing those 2 problems, the antidote to that I see is fundamentally 2 different things. One, we need to be able to build faster. Australia's construction industry has been very much with traditional construction methods for a very long period of time, and we're not embracing new technologies to build our houses much faster. Mm-hmm. And since COVID, we've actually doubled the timelines, and what a house that used to take 6 months is now taking 12. So we need to get faster at actually building. That will, reduce our holding costs. It'll reduce our exposure and risk to the market, and it'll also mean that the fewer number of builders that are remaining will actually be able to do more jobs if we can build faster. So that's point one. point two is we need to reduce the cost of construction by reducing the cost of building materials and that sort of thing. So my expedition, for want of a better word, was to try and investigate those two things, and I took it upon myself to reach out to, I guess, the Canton Fair officials and speak to there, and also the Shenzhen government and a couple of others. Australian Trade and Investment Commission, Trade Investment Queensland were over there. I guess a number of their local government departments, and about 120 odd suppliers, I guess, in front of an audience of all of those, and told them how Australia is going to be the antidote to these Trump tariffs.
Very interesting. Okay, so my first question is, how could these Trump tariffs potentially affect property developing in Australia? And listening to what you've said there before you even answer the question, I'm guessing positively.
Absolutely. So we did a number of factory tours of a number of different suppliers in a range of technologies, from pod constructions to aluminium doors to massive tiling companies. Like, we had a look at some factories very, very tiny and absolutely mega scale. And especially the guys that are in the mega scale department, they have been creating a whole bunch of stock that has been going in a lot of directions, including the US, and now can't go there, or won't go there, probably more predominantly. And so they've got this machinery, I guess, creating a whole bunch of stuff, and they're looking for new markets to do. And they're all looking at Australia going, you guys are, I guess, a huge opportunity for us to actually pivot what we're doing, bring it up to Australian standards and ship across. So we're in discussions with a number of different manufacturers to say, hey, how do they actually get into the Australian market and start to, I guess, capitalise on the fact that we have been, I guess, under-resourced in the technology department for a very long period of time.
Can you open up a little bit about actually what it was like walking through the Chinese factories and the manufacturing side of things? Because is it still a bit of a mixed bag, or is it like, what's it like?
Absolutely. So there's very, very small scale operators that are very manual labor, where I guess there's no automations and machinery and that sort of thing, and it's pretty much done in a sweatshop, for want of a better word. But then there's the extreme opposite of that. Then there's the mega factories. So there's one housing provider that we went to in particular. This was one of 5, I guess, factories that he had, and the one warehouse where they were constructing out of the 5 that was on that campus. So, 5 sheds was a 32,000 square meter shed that had a mezzanine floor that was equally 32,000 square meters. Now, to put that into context, that is an 80-lot land subdivision sitting on top of another 80-lot land subdivision inside a shed where they're manufacturing, I guess, modular housing.
Is that like a 20-acre factory?
Yeah.
That's insane. Okay, and this is one
Correct.
of the places that you went to. So obviously there's still a stark contrast between maybe places that you might not feel comfortable doing business, but then there's places that are super switched on and very modernized. Yeah,
and we also did one factory tour that we went in there at 9 p.m. at night. It was a 24-hour facility, and so at 9 p.m. at night, they're more than happy to walk us through because everything's still under full production. So they're not shy in their work ethic is next level.
So as far as how the tariffs could affect developing in Australia, it's sounding like everything is still going full swing. It doesn't have the same market to go to in America. So it's a little bit more open arms Australia. What do you guys think?
I think there's a number of opportunities for early adopters in Australia to actually start to embrace, hey, how do we actually take on these new methodologies? And there's going to be a number of different suppliers over there that are going to look at Australia with open arms and say, we would love for you, Mr. Developer, to be the shining light where we can actually showcase our products and our capabilities and that sort of thing. And so there's a number of people, and I'm hoping to be one of those for the record, that will be able to showcase these new technologies and become a flagship for them, and open up a floodgate of opportunity.
Can you open up a little bit more about new technologies? Because like you and I have just discussed like the container homes, the fold out sort of granny flat stuff like that. Like I'm not against them. I've walked through them, but I'm not exactly for them just yet. But I'm very open to this new sort of stuff. Like what did you see that was like, hey, this has really got potential?
Well, I actually did a presentation, as I touched on, to, I guess, the Canton Fair themselves, and also, I guess, the Australian Investment Commission, the Shenzhen government, and a number of others, talking about the exact technologies. A lot of them have actually been I guess, created in China. Mm-hmm. So pod housing is one of them, and we are used to seeing containers, okay? So a shipping container converted, and look, it's functional, but it's not pretty, okay? Mm-hmm. And that is at the budget end, but there is also a different level of modular. So there's another level of modular, which is not constrained by the shipping container sizes, but it has the same concept, but you can have much larger spaces. So you could have like a 10-meter void in your apartment, for example, or in your house. You could have massive houses, and that might be a combination of 10 modules all plugged together, every single one of them customized, prefabricated in, but none of them all of the same size. Okay. So they then bolt together like Lego bricks.
Right, but they're not all the same size Lego brick like the container home style.
Well, if you actually think of it like actual Lego, you get the Lego which is one brick, and then one which is two bricks, and one which is four bricks, and then
good point.
And so with that, you can create the Eiffel Tower, you can create an 800-pound gorilla, you can create all these different things. So these things can be a 2 or 3 story townhouse. They could be I guess a luxury home. They could also equally be an 80-story apartment complex.
Okay, so this is kind of like volumetric construction.
It is exactly volumetric construction. That is what it is called.
Okay. So as far as the potential opportunity here, you're looking at this like this could then drastically reduce the cost of construction, because what part of the construction process would then be happening overseas and coming to Australia? Yeah,
so I guess using cheaper materials and cheaper labour to, I guess, assemble it into, I guess, the actual pod itself, and then assembling it here in Australia. So there's a number of challenges that need to be overcome in order to do that. But that's not the only thing. There's also prefabricated panels. There's also, I guess, different technologies in how you can actually build apartment complexes. So you can do lightweight construction anywhere up to 10 stories. So using wood, in case you hadn't thought, using wood apartments. So there are a couple of those already in Sydney and a couple of those already in Melbourne, where you can actually, some of them are up to 10 stories tall. You can also do steel frame construction. You don't need to do the traditional concrete core of an apartment complex anymore. But you can also do steel floors. So if you start to combine a couple of these technologies, you put a panelized wall system inside a steel framed apartment complex with a pod bathroom and a pod kitchen going in and a couple of other things like that, and all of a sudden you're building very, very fast.
Now, we've already spoken to Morgan Bushell about how potentially interest rates could come down. There's a lot of the big banks now basically going, look, some are even saying the cash rate could potentially go as low as like 2.5% in the next 12 months. Not everyone's of the same opinion, but who knows? What I'm kind of hearing though is he was also saying that HEM, like household expenditure measure, could potentially go up because cost of living could rise because of this. It sounds like what you're saying, this could potentially be a bit of a controversial one. Is this potentially going to come at the cost of more Aussie jobs, or are you looking at this as more of a solution to the lack of skills or the skills shortage we've got in Australia to kind of complement it instead of costing the jobs? Do you know what I'm saying?
Yeah, I don't think it is losing jobs. I think it is reskilling and retooling to do different things. And so a builder who let's just say a small scale builder who can only do 10 homes a year can now potentially do 40 homes a year. Same builder with the same tradies and the same team, he can just get through more work. Rather than being afraid of this technology, it should be about embracing it. Examples of machinery that do laying of bricks, laying of tiles, laying of 90% of the manual labor can actually be automated with an operator. You still need the skilled tradesman to come and do the edging and the finishing of this. But if you're doing a large lounge room, for example, you just need the skilled labor to do the edging. But the actual floor can be laid out.
Unless you're talking a 3D printed house, but that's a whole nother episode.
Well, that's that. Let's do an episode on how to fast track building a house, mate.
I actually would like to do that, but that's another discussion. So I've got to ask then, with so much volatility in the stock market, and I know it's rallied a bit recently, like literally from filming the very first panel of this episode to now, like today, whatever it is, like the 29th of April, I think there's already been a few changes with the tariffs. The stock market started to recover a little bit, but it's still taken a massive hit in just about every market around the world. Why is Aussie property immune to this? Why is it safe?
I think there's two parts to this answer. So part number one is the Australian economy itself. Part number two is the tariffs and the purpose and intent of the tariffs. I'll address the second one first. The cynic in me is listening to all the people with tinfoil hats and that sort of thing saying that the reason that Trump is actually trying to do this is actually to deliberately cause issues and challenges in the stock market in order to opportunistically buy low and then reverse the trend and then everything shoot back up. So it furthers his nest a lot better. So there's a lot of, let's just say, propaganda that's talking all about how he's feathering his own nest in actually doing this. And this is a play for him to get a larger market share.
And we'll never know if it's true or not, but there's parts of it that make sense.
Yeah. So I'm going to leave the politics of that alone. I'm just going to say that is and which side of the fence I'm on, I'm not going to say, but I think that's just a pin in the wall. But with regards to the Australian economy, I guess the property market or the property sector and construction in particular is the second largest employer in the country. By the time you actually think about all of the knock-on industries that are actually impacted by this, you've got, the builder themselves, then you've got all the tradies, then you've got the fact that there's going to be somebody buying a home, which then means that you've got conveyancers and legals and finance, you've got sales agents, you've got a whole bunch of people. Then if it's an investment property, you've got property managers. So the knock-on effect of one house being created means that the property industry and the amount of money that it actually turns over is the second largest employer in the country. Okay, so mining is the only thing bigger. Mm-hmm. Okay, so when we look at the that side of things, the Australian government has no choice but to prop up the Australian property market. It's exactly what it did during COVID. If anyone goes back in time and has a look at some of my YouTube channels at the time when everyone was talking about 20 and 30% property market drops, I said at the time, there's no way that the government can allow that to occur because every bank would actually go broke. So this is functionally the same thing here, because the property market creates jobs and it creates, all the knock-on effects of that. The government will do what it needs to do to keep that market moving. We are a property economy, whether we like it or not.
So essentially, your answer feels like it boils down to it's too big to fail.
Correct.
Okay. Realistically, it makes sense. I've listened to a lot on this about how mining and property is like essentially, and superannuation is the other one from what I understand, which are two of the things that actually make Australians the one of the richest people per capita. We've got amazing wealth as an average. I know obviously not everyone does. There's definitely people much better off than you and I, and there's people that are much worse off. But realistically, we're pretty good as a country as a whole, and a lot of that is due to property and superannuation, from what I understand.
So the too big to fail comment, I'll stand by that, but I guess there's an asterisk beside it. It's not that it can't fail, it's that the government can't afford it to fail, so the government will do what it needs to do to make sure that it doesn't.
That's a wonderful way of putting it. Okay. So it's not a cure all. It's not it can't happen. It's everything will be put into making sure it doesn't.
Correct.
Makes perfect sense. Going to our last question is something that I feel like we've kind of already answered. What's the potential opportunity here that people are going to look back on nostalgically and go, I wish I did that? And I feel like it's potentially, from what you're saying, understanding better construction methods that might be cheaper, faster, more cost effective. Well, this is another just way of saying cheaper, but potentially going over to China, actually seeing it for yourself, getting on the ground first before it becomes a norm. Are these the opportunities that you think people might be missing?
I think there's opportunities for developers, opportunities for builders to say, embrace the new technology. You can create more in a shorter period of time with the same amount of materials, the same amount of labor, same amount of skills. For, I guess, the homeowner, for the investor, for, I guess, the audience out there that actually just wants to buy the finished product, look at it with open eyes. The quality of the product that is actually being created in many instances is actually better than what is actually being constructed by hand. And so it's one of those things where I think we're all afraid of what it might look like. I remember when the electric vehicle's taken 120 years to take up popularity, right? I think it was Henry Ford that came out with the electric vehicle, but Elon Musk made it popular, okay? Exactly. At some point, it's going to become popular. Now, the rest of the world have been doing modularized construction for 40, 50, 60 years. All of Europe has been modular for eons. All of China, all of Japan, they've been doing modular housing for a very long period of time, 20, 30 years. Australia has just not cottoned onto it. I think that this is the turning point to say we are going to change our construction methodology very, very soon. And we are at the cusp of what will be that change right now. And I think the opportunity is to embrace it early, be an early adopter. There's a small element of risk with regards to will the market accept it, but it's inevitable that they are going to, because it's the only way that we can build fast enough to solve the housing crisis, because at our current rate, we're going to be 400,000 homes short in the 5 years that the government wants to achieve 1.2 million homes. And it's the only way we're going to solve the housing affordability is by reducing the cost of construction and reducing the risk that we've got of builders going broke halfway through a build because they can't keep the throughput through and the cash flow up. So it solves many, many problems.
Right, so the real opportunity here is don't be afraid of the new technology. Like, look into embrace it. Got it. Rob Flux from Property Developer Network. Thank you so much for jumping on the show, mate. It's always a pleasure.
You're welcome. See you guys.
Now, to me, this is fascinating. Personally, I agree with a lot of what Rob's actually talking about. And he's at the forefront of it, like literally going to China, actually like touring the factory, seeing all this. This isn't just having a quick Google and thinking maybe there's a bit of opportunity here. I think it was Plato that said, necessity is the mother of invention. Actually, I lie. I don't think. It says it on the screen in front of me. I'm definitely cheating there. It was Plato that actually said that. We're in a housing crisis. No one is coming up with good solutions. Everyone's got opinions. Everyone's got, and pretty strong opinions on both sides of the scale. Obviously, I'm biased. I'm a property investor. But there is no debate that something needs to change. Maybe this is one of the things. Maybe this is one of the times where we lean into new invention, new construction methods, more cost-effective ways of actually producing housing to actually solve this problem that we're in. And I think it's something that we're going to watch really closely. And people like Rob at the forefront of it are potentially going to be pioneering a lot of amazing solutions moving forward. But as far as how the Trump tariffs are actually changing things, one of the big positive takeaways I got from that is there is factories over there like the size of multiple football fields that are still producing so many goods, and they don't have the same America to send it to. Well, like they can, but tariffs. So it's not cost effective anymore. Those products need to go somewhere. If you're renovating, if you're developing, if you've been thinking about adding value to your house, it's time to start having a look at what products you could potentially be getting at amazingly cost-effective rates. But you don't need to maybe fly there like Rob just did. But again, keep that open mind. Whilst everyone else is losing it, what can you be doing to go, hey, how can I actually make this work pretty well for me at the moment? I think this is a space to watch really, really closely. And last but certainly not least, on our expert panel, we've got lead research analyst from InvestorKit, Junge Ma, opening up more about the data of what these tariffs actually mean for us as Australian property investors.
Junge Ma, how you going?
Not bad. How are you?
Very good. It's always a pleasure to see you. I'm looking forward to you pulling apart the Trump tariffs right now from an Australian economics and data perspective. But like before I jump into all the questions with you, because you've always got a wonderful way of simplifying the complex, is there anything that you wanted to kind of set the stage with, or do you just want to jump straight into it?
Let's jump straight into it.
Perfect. Okay, question number one. How could the Trump tariffs economically and also from a data perspective really affect Australian property moving forward?
Okay, I don't think the impact would be really large. The first thing I can think of is the decrease in consumer confidence. As we saw in the latest months, which is April's consumer sentiment data, it actually dropped from the peak in March. From around 96 points to around 90 points. It happened in April. Can't be coincidence because the tariff was announced, I guess, sometime in March and came effective in April. So this drop, I believe it has something to do with the tariff.
Absolutely. And like things are changing so quickly right now. Like even from the start of making this episode to now, like you and I are recording this on, it's, what is it? It's 9:14 in the morning on Friday morning, Friday, what is it? The May the 2nd. Stuff has already changed just in the past week. So to say that consumer confidence is down, 6 points essentially just in the last month, Is this something that you're looking at with a bit of a concern of it continuing to trend down, or like how do we read into this?
I don't think it's a big concern for now. The reason is, as you said, things are changing so fast. We don't know what's going to happen in the next month. A lot of countries are fighting back, and the situations in the US are not looking so good. So it's possible that these policies will change in the coming months. When COVID happened in 2020, the consumer confidence really dropped in early 2020. But in August, just in September 2020, it started bouncing back. So all these shocks, I don't think their impacts would last too long to consumer confidence.
What are the other things that we really need to be aware of? Because a few people have already suggested rates potentially dropping. I'm really eager to hear your thoughts on this. Is this something that the data backs up from your perspective as well? That it's like, yeah, I'm agreeing with a lot of these forecasts of rates coming down faster?
Yes, this is one of the signs. Yeah, I do agree with the more cuts forecasts, because right, they are based on all the big banks' models. They're usually more reliable than what our ordinary people think. And two, the drop in consumer confidence is not the only reason why everyone's saying we'll be seeing more rate cuts. It's more based on the assumption that if the tariff continues, the economy of Australia and globally will potentially slow down. To prevent that, the RBA would want to make more rate cuts to stimulate the economy a bit.
Got it. It's the one lever that they can really pull. Like okay. And so as far as rate cuts are concerned, this right now feels unanimous amongst every expert we've had on the panel, that everyone is looking at this going, yeah, we actually pretty much all agree with rate cuts are coming. Like I've just got that Game of Thrones meme in my head right now. The winter is coming. Like, but it's good news. But then it's good news and it's potentially bad news because they're coming because there is potentially going to be some economic slowdown. Can you open that up a little bit more as to like what could we expect if the tariffs don't change, if this really does just go full steam ahead? Like I read an article just this morning and it was about Trump is furious with Bezos apparently because Bezos is actually posting next to the price of everything on Amazon what the tariff cost is. And so he's furious, but he's trying to be like, hey guys, this isn't actually us putting the prices up. So I can see this maybe going back and forth for a little bit. But again, for us as Australians, What are the other sort of predictions or other points of data we really need to be aware of that could affect us?
For Australians, I think the more impact would be coming from the slowdown from our major trading partners like China, Japan, or Korea. These three countries, they all have tuned down their growth forecast for 2025 and 2026 as well. Okay. For example, Japan recently lowered their GDP growth expectation from 1.1% to just 0.5% for 25. Korea did something similar. They lowered from 1.9 to 1.5%. And for China, I'm not looking at the government's forecast because it's not really reliable, but many investment banks, such as Goldman Sachs, their forecast has been decreased from 4.5% to 4% for China's GDP growth this year.
I want to know, so everyone is basically going, it's going to slow down. Is there any country in the world that's like rubbing their hands together going, nah, this is good times? Or is the globe collectively going, yeah, this isn't good?
I didn't check every country's GDP forecast, but as almost all countries are now connected with each other, I do think at least most countries would be expecting less growth.
And so if we're looking at it through that lens, then what I'm basically hearing is it's potentially time to maybe boost the savings. And whilst this is not financial advice, but I can't see this being bad financial advice to say maybe save a little bit of money, have a little bit more of a buffer behind you at the moment, because if we do have a bit of economic instability, having that extra savings, if there is maybe a potential opportunity, could also help take advantage of that opportunity and invest in it as well, or could be used to just get you through times if they do get a little bit tricky. Because it sounds like you're saying every country in the world is basically saying things might get a little bit tricky.
Yeah, totally agree. But I guess, I actually have heard investors or big investors saving more or turning many of their assets into cash. But at the same time, we're not talking about a economic collapse. There will still be opportunities for investment, and there will still be some growth. And I guess for Australians, this country at least is more of a safe haven for compared to the others like the US, China, or Europe.
And you
so in Australia, sorry.
No, you're right. We were having a chat about this off air before as well. And it's one of my questions is like, what makes you confident that, like with stock markets really going down, what makes you confident that the Australian property market's still a really safe store of wealth? And you started expanding on this in like a lot of detail, talking about, because for the rest of the world looking at Australia, we look really good in comparison. Can you kind of open that up a little bit for us?
Yeah, right. So now all the major economies, they are all having their own problems. In the US, it's not really political or economical stable. And in China, same thing, affected by the tariffs, affected by the high government debts and everything. In Europe, there's the war between Russia and Ukraine. Almost all these major economies are having issues, but Australia is not involved too deeply with those things. It's much more stable in both the political environment and economic and economy.
We're just that big chill island, just too far away from everything, aren't we?
Kind of.
Yeah, but I hear what you're saying. So basically you're looking at this going like, if you're a foreign resident that can actually invest in Australia, and I know this is obviously a very controversial topic right now, because in the middle of a housing crisis, there's a lot of people that will be on each side of the fence of this is good, this is bad. But if it's just the way that it's looking economically right now, this is just the way that it's looking right now. And from what you're saying, we are a very stable economy. We have been, like, historically, you look through the GFC. I don't know. I was drunk during the GFC. I don't remember much of it, but I do remember though, things weren't that bad here in Australia. But the rest of the world though, there were places where it was proper pain. we tend to really skate through these kinds of things pretty well. And like, knock on wood, I don't want to jinx anything for the entire country, but I can see what you're saying, that globally, there's probably a lot of other people in different countries kind of going, maybe Australia is the place that we could put our money now. So I can see this being another reason. So apart from that, what else gives you confidence that we've got the strength in the Australian property market?
The property market, you're right. One, compared to the stock market, it moves slower. There's less liquidity there. So it won't react to these shocks that quick, making it more stable. And the second thing is, when we talk about Australia's property market, we always have to look at the fundamentals. And the fundamentals are still looking good. Yeah, by fundamentals, I'm saying demand and supply.
Okay, and so basically we've still got such a huge supply shortage. We've got so much demand. Like we've got a lot of people coming to the country. So you're looking at that and just going, okay, so even if there is a bit of economic instability on a global scale, we've still got a huge supply-demand issue.
Yes, right. Demand now is the increase is slowing down. I'm talking about population growth. In the first quarter of 2025, population growth finally came back to the long-term average level, which is around 1.5, 1.6% per year. But in the past 2 or 3 years, as the population surged, we've accumulated a lot of shortfall housing supply. And when we look at shortage in supply, we can look at two things. One is the shortage in established supply, which is the number of for sale listings. Now, the for sale listings on the market is 21% lower than 5 years ago, before COVID happened. That's a big shrink. And then the second thing is incoming supply, our constructions. So based on an AMP estimate, we are now looking at a 200,000 to 300,000 shortfall in homes compared to our new housing demand.
For anyone that just watches us on YouTube, on Fridays on Spotify and iTunes, we do a weekly news show. It goes like 3 minutes, called APN. I don't think I've once read out an article on APN that talks about how we're actually meeting housing demand. It's probably once a month, once every couple of months, there's like a new report in that we're short X amount of hundreds of thousands of homes still. Like, it feels like, is this just this impossible target that's just never going to be reached? And it's one of the things, again, coming back to this fundamentals and the supply-demand issue that really just keeps Australian property prices, I guess, that safe haven for a store of wealth?
Right. And also, to make it worse, the tariff is actually contributing to the construction cost increase. So it's actually further slowing down our supply.
We actually just chatted with Rob Flux, I think it was yesterday or the day before, and that was all about how he literally just got back from China talking about new construction methods, though, and how that can potentially bring the cost of housing down. However, those new methods need to be adopted. They need to be streamlined. Right. They need to be, like, that's nothing that's going to happen in the short terms. So you're talking about short term, basically our stuff is going to get more expensive that we use to construct homes.
Yes, like steel, like aluminium. These are staple material for construction.
All right, Jung, so ending this on more of a positive note, or potential positive note, I want to say, what, in your opinion, is maybe that opportunity that we're all going to look back on nostalgically and go, oh, I should have done that during that tariff time?
So the opportunity I see here is, it's actually a very personal perspective. Okay. I'm currently with a small lender for one of my properties. And I guess in 2025, as we are having more certainty in interest rate drops, I think it might be a good time to talk to my broker and see if I can refinance to a bigger bank or to get a better interest rate.
Got it. Okay. So basically you're saying if you're with a second or third tier lender, because maybe you couldn't meet the criteria with serviceability with like a first, like one of the big banks, this might be a time to actually chat with your broker and see, does it actually service now? Because you could actually save yourself, on top of the rate cuts, a more competitive rate. Is that right?
Yes. And also, I guess with bigger banks, it feels safer.
I love it. Anything else that you wanted to add to that?
Another thing, I don't think it's an opportunity for most investors or home buyers. It's actually a trend we're observing right now. It's around the upper quartile markets in our major cities. I guess I'll explain that a bit.
Yeah, what do you mean?
Yeah, we were talking about interest from overseas investors a few minutes ago. And Australia's property market is one of, I guess, markets they can invest in. But when it comes to international investors, the major cities and their central parts should be the most attractive, like Sydney's Harborside, Melbourne, Brisbane's Riverside, or the really premium areas, or the Gold Coast. These areas, they are one more well-known, and two, they will seem safer because of their big size.
Got it. So is it kind of like the equivalent of like when you think of America, stereotypically you think of like LA, Miami, New York. So you're essentially, when people think of Australia, they think of Melbourne, Sydney, Goldie, or Brisbane. Like it's those kind of three spots. So what you think the Adelaides, the Darwins, the Hobarts, they kind of get forgotten out of that picture from more international investors?
I do think so. For foreign investors, the most well-known cities, for them, it's more diverse in economy, although it may not be necessarily right. It's just a matter of it's a psychological thing.
All right, Jung. So in short, basically what we're looking at is consumer confidence has taken a bit of a hit because of all of these changes. We're looking at rate cuts coming down faster than what people were expecting. Well, I said people, like the economists, the big banks, everyone was really predicting to begin with. We're seeing there's potentially going to be a rise in costs of building though. So again, and this, I said this when I was chatting with Morgan Bushell, it feels like kind of taking with one hand and giving with the other. So this might be a bit of a non-event in some cases, but in others, there's some real positives to it. The fundamentals of the Australian property market, at the end of the day, we've got a massive supply shortage. We're very attractive to the rest of the world as far as our stability is concerned, which then could push more of the market up. But again, like you and I were chatting a little bit off air, most of those markets are probably going to be more like Sydney, Melbourne, Brisbane, like those. Whenever I go overseas, no one says, "Are you from Adelaide?" Everyone's all like, "Oh, are you from Melbourne?" It's how the rest of the world looks at us. So it's going to be the bigger cities that potentially feel that a little bit more rather than the smaller cities or regional cities. And as far as your potential opportunity in this might be a really good time to talk to your broker and go, what does my serviceability look like? What are my options now? If I'm on a higher interest rate with one lender that won't come down the same way, can I actually refinance back to someone that's going to give me a much better deal? I think that's brilliant, Jung. Is there any other final words of wisdom or anything you want me to add to this one today?
If anything, I guess I want to re-emphasize the point I think I mentioned before. It's just a short-term shock. As the outbreak of COVID, it may affect, to some extent, the property market in the short term, but in the medium to long term, the market adjusts itself, and the long-term growth of Australia's property market will still be good because of the fundamentals.
Junge Ma from InvestorKit, it is always a pleasure having you on the show. Thanks again for your time.
Oh, my pleasure. Thank you so much.
I'm very pleased to hear Jung completely agreeing with the potential, very strong potential. No one's going to say guarantee just because it's finance. That word never gets used. But the very strong potential of rate cuts coming. But also clearly showing consumer confidence is down. And whilst it hasn't plummeted, it hasn't fallen off a cliff, again, it's speaking to that uncertainty. But coming back to looking at the data, that like I was genuinely expecting Jung to like have this massive, oh, well, because of this big thing's happening, or because of this other data point, like this big thing's happening. But I'm kind of pleasantly surprised to actually hear it's like, no, like just stick to the fundamentals. Have you seen the common theme here? There's no massive changes that are on the horizon. Maybe something else is going to change. Again, that's what uncertainty is about. No one knows for certain. But there's nothing that's really pointing towards like this, oh my God, take cover, get in your bunker. But the way the media reports this, you'd kind of think that that's what's about to happen. So for me, what I've personally learned from this, stick to the plan. Maybe increase your savings because cost of living might be going up. Cost of living has already gone up, but it might be going up again. So if you can increase that savings buffer, you're never going to lose by having a bigger savings buffer. Get ready to talk with your broker. Don't sit on the fence about that. If you're looking at refinancing, get in as soon as you can. As soon as rates start moving, have a talk with them. Keep an open mind and check for new construction methods. And that one's not going to happen overnight. But the thing that will happen overnight is an excess of construction materials that need buyers. In short, I feel like these tariffs shouldn't be ignored. It's a real thing. It's going to have some very real effects on a lot of us in totally different ways. But as far as answering the question of how much for us specifically as Australian property investors, the answer is, apart from some interest rate cuts and a few other changes here and there, not a massive amount. So I hope this episode has put your mind at ease more. And if you've got that friend, that family member that is getting really concerned, that is thinking, what if, show them, send them this episode, because these are literally some of the brightest minds in property in Australia right now. Talking about the pros, talking about the cons, none of them talking about the world is ending. None of them talking about it's all doom and gloom. If anything, I just keep hearing rate cuts, rate cuts. Now, granted, I know I'm being selfish with that, but it's what we've all been wanting for ages. Do you remember how good 2.5% rates were? Like, how good was that? I know those days aren't coming back anytime soon, but if we can get 0.5% to 1% off, it's going to be pretty good as Aussie property investors. I hope you guys have enjoyed this episode. And if you're wanting more panels like this, make sure to leave a comment below. Tell us what you're wanting us to assemble an expert panel on next. My name's Todd Sloan. This is the Pizza and Property Podcast. I'll see you on another episode.